The number that just appeared in the COMEX Vault report should worry every bank that is trapped on the wrong side of this silver trade. 87 million ounces. That is all that is left. That is the total amount of deliverable silver sitting in the registered category of the COMEX vaults right now. This is the silver that is tagged, approved, and legally available to be handed over when a futures contract holder says, "I do not want cash, I want my silver." 87 million ounces. That figure is down 31% from just a few months ago. It is down 38% since October. And it is leaving the vaults at a pace of about 785,000 ounces per day. Now compare that shrinking pile of metal to what just happened in the March 2026 delivery cycle. On first notice day alone, delivery notices were issued for 10,126 contracts. Since each silver contract represents 5,000 ounces, that means 52.63 million ounces were demanded in a single morning. Think about that for a second. More than 60% of all registered silver in the vault system was spoken for in one day, and the total open interest for the March contract has been reported in a range equal to roughly 300 to 429 million ounces. In this video, I am going to walk through the squeeze math. I am going to show you what the data says, what it does not say, and what the realistic scenarios look like as we move into what could be the most important silver delivery month in modern history. This is Bridgeport Channel, and the numbers you are about to hear are not opinions. They come from CME delivery reports, COMEX vault data, and reporting cited from sources such as Shift Gold, Seeking Alpha, Market Minute, and the Shanghai Futures Exchange. In a market this volatile, trust matters. So let us start with the math. First, we need to look at the inventory data because this is where the whole argument either stands or falls. The COMEX vault system holds silver in two categories, registered and eligible. These two categories are not the same thing, and mixing them up is one of the biggest mistakes people make when talking about silver. Registered silver is the metal that has been officially approved by the exchange for delivery. It is tagged, warranted, and ready. This is the only silver that can legally be delivered when someone stands for delivery on a futures contract. As of the latest vault report, registered silver sits somewhere around 86 to 88 million ounces. For simplicity, call it 87 million. Eligible silver is different. It is silver stored inside the vaults, but it is not available for delivery. It belongs to banks, ETFs, institutions, or private owners who are simply using the vault for storage. There are roughly 400 million ounces of eligible silver in the system. But here is the key point. That silver cannot be used to settle futures contracts unless the owner chooses to reclassify it into the registered category. And in the current environment, with strong demand and prices still elevated, owners of eligible silver have very little reason to volunteer that metal. In fact, according to the analysis referenced in the original discussion, even eligible inventories have also been leaving the vault system quickly. The silver is not just being moved from one category to another. In many cases, it is leaving the system entirely. So when someone says there are almost 500 million ounces of silver in COMEX, that is technically true. But only about 87 million ounces of that is actually available for delivery. The rest is effectively behind a locked door, and the exchange cannot open that door unless the owner agrees. Now let us move to the demand side. On first notice day for the March contract, 10,126 contracts stood for delivery. At 5,000 ounces per contract, that equals 52.63 million ounces in a single day. That one figure alone represents more than 60% of all registered silver. And then we get to the number that changes everything. The total open interest for the March contract has been reported as high as 429 million ounces. Now historically, most futures contracts never end in physical delivery. In a normal year, around 99% of contracts are closed, rolled forward, or settled in cash. Traders take profits, exit positions, or move into the next month. That is how the system usually works. But this is not a normal year. So let us run 3 simple scenarios using the actual numbers. This is the squeeze math. Scenario 1. If delivery demand remains around the current 52.63 million ounces and no major wave of additional contracts stands for delivery, then COMEX can probably fulfill that obligation. It would still drain around 60% of registered inventory, leaving the vaults extremely thin going into the May and July delivery cycles. That would be painful, but still survivable. Scenario 2. If 25% of the remaining open interest demands physical silver, then the amount of metal needed rises to about 100 million ounces. That is already more than the full registered supply. In that case, COMEX would need to persuade owners of eligible silver to reclassify their metal, source silver from outside the vault system, or offer cash settlement incentives to encourage contract holders to give up their right to physical delivery. Scenario 3. If 50% of the remaining open interest stands for delivery, then demand jumps to around 214 million ounces against just 87 million ounces registered. That creates a gap of about 127 million ounces. There is no easy mechanism that closes a gap that large without a major repricing event. Now, I want to be very clear here, because this is where some channels lose credibility. The most likely outcome is not scenario 3. History still tells us that most contracts will settle in cash one way or another. The CME has tools it can use. Margins have already been raised from 15% to 18%. New cash-settled contract alternatives have also been introduced. And if pressure builds, those tools can be used even more aggressively. But something important has changed. The behavior of the long side is changing. In January 2026, which is normally a quiet month, about 49.4 million ounces of silver were physically removed from COMEX. That was reportedly 4 times higher than January 2025. According to the figures cited in the original transcript, nearly 19 million ounces were requested in just the first 5 days of February. There are also reports that contract holders have been rolling positions backward into earlier months in order to get metal sooner. That is not normal paper trading behavior. That is what entities do when they want the actual physical commodity. In 2025, total silver delivery reportedly reached 474.4 million ounces, roughly double the level of 2024. The trend, at least based on the numbers presented, is moving in one direction. Physical demand is increasing. So while COMEX is unlikely to declare a formal default, the safety margin is getting thinner than it has been in a very long time. And when margins get thin in a volatile market, that is when accidents happen. There are 3 warning signals flashing right now that have historically appeared before major market stress. Warning signal number 1, backwardation. In a normal futures market, a contract for delivery several months in the future usually trades above the spot price today. That is called contango. It reflects storage costs, financing costs, and the normal structure of a healthy market. But silver has been trading in backwardation. That means the spot price is above the futures price. In simple terms, the market is saying that silver you can hold today is worth more than a promise of silver later. That is not normal. That is a sign of tight physical supply. It tells you the market is placing a premium on immediate access to metal. Warning signal number 2, lease rates. Silver lease rates reportedly surged to around 8% in early 2026. To understand how unusual that is, normal lease rates are often closer to 0.3% to 0.5%. So 8% is not just high, it is extreme. A lease rate is basically the cost of borrowing silver for a period of time. When institutions are willing to pay that much just to borrow metal, it suggests that physical silver is hard to find through normal channels. That is another shortage signal. Warning signal number 3, the Shanghai premium. Physical silver on the Shanghai market has reportedly been trading at an $8 to $13 premium over New York prices. That should not normally happen for long in a well-connected global market. Usually, traders would buy silver where it is cheaper, move it to where it is more expensive, and profit from the difference. That process is called arbitrage. If the premium remains in place, it suggests that the normal flow of metal is not working smoothly. And one major reason discussed in the original transcript is China's decision, effective January 1st, 2026, to classify silver as a dual-use strategic material and place tighter export licensing controls on it. If China, one of the world's dominant silver refiners, reduces exports significantly, then global supply chains do not just tighten, they break. So look at the full picture. Backwardation, exploding lease rates, a persistent Shanghai premium. Each one alone would suggest physical tightness. Together, they paint a picture of a market under serious strain. But before anyone gets too excited, we also need to talk about what happened on January 30th, 2026, because this market has already shown how violent it can be in both directions. On that day, silver futures suffered a brutal one-day collapse of 31.4%, settling at $78.50 according to the original transcript. That was described as the worst daily decline since the Hunt brothers era in 1980. Silver had reportedly been trading above $121 earlier that week. Then, in just hours, more than $40 per ounce disappeared. The triggers were specific. President Trump nominated Kevin Warsh, known as a monetary hawk, as Federal Reserve Chair. That caused markets to reprice interest rate expectations. The dollar strengthened, Treasury yields jumped, and the CME also raised margin requirements by about 36%, forcing many overleveraged long traders to liquidate. This is important. That was not a change in physical fundamentals. The physical shortage did not vanish. The vaults did not suddenly refill. Export restrictions did not disappear. What happened was a liquidity shock. Leverage got crushed. Positions were forced out. The move was violent, mechanical, and predictable in hindsight. And that leads to one of the biggest lessons in this market. Being right on the fundamentals is not enough. You also have to survive the volatility. The people who held through that crash without being forced out are the ones still standing for delivery now. The ones who were over-leveraged were wiped out. Silver has since stabilized in roughly the $80 to $94 range, based on the transcript you provided. And if the physical fundamentals discussed here are accurate, they have only tightened since that crash. But the crash still happened, and it can happen again. The CME has raised margins before, and it will do it again if it believes the delivery system is under pressure. That is one of its main tools, and it will not hesitate to use it. So where does all of this leave us? Let me give you the honest version. Not hype, not fear, just the data as presented. The bullish case is built on real numbers. Registered inventory is near multi-year lows. Delivery demand is running at historically high levels. The market has reportedly been in a structural supply deficit for years. China is restricting silver exports. Lease rates are signaling severe tightness. And major institutions have reportedly started shifting their positioning. Those are serious bullish factors. But the bearish risks are also real. The CME can raise margins again, which could trigger another forced liquidation wave. COMEX can use cash settlement mechanisms, making a formal technical default less likely even if physical supply gets extremely tight. A lot of speculative excess was already flushed out during the January crash. And if the Federal Reserve under a more hawkish chair keeps interest rates higher for longer, that can weigh on precious metals. So here is what the data suggests. The physical silver market appears to be in a real structural deficit. The COMEX delivery system appears to be under more pressure than usual, and the March delivery cycle looks like a major stress test. If the system gets through it, it buys time. If it struggles, the consequences could spread far beyond silver itself. The number to watch is registered inventory. If that number falls below 50 million ounces, then the situation becomes extremely tight. At 87 million ounces and falling by about 785,000 ounces per day, that threshold is not far away if the pace continues. And that is the real point of this video. The silver market is not a place for certainty right now. It is a place for preparation. Anyone who claims they know exactly what silver will do next week is either guessing or selling you something. The 31% crash on January 30th should have made that obvious. But what the data does show very clearly is this. The amount of deliverable silver in the Western exchange system is shrinking quickly, while demand for physical metal is rising. Those two lines are moving toward each other, and when they finally cross, something will have to give. Maybe it is a sharp price spike. Maybe it is a cash settlement event. Maybe it is another margin-driven crash. That depends on decisions made inside clearinghouses, exchanges, and bank boardrooms in the coming weeks. Your job is not to predict the exact trigger. Your job is to understand the math so that whatever happens, you are not caught off guard. 87 million ounces, more than 52 million ounces demanded on day one, as much as 429 million ounces tied to open interest. And the clock is now ticking on the March delivery cycle. Every number referenced in this video should be checked against the underlying reports and sources before making any financial decision. If you found this useful, share it with someone who needs to see the real data instead of just the hype. Subscribe for the follow-up when the next March delivery numbers come in. I will be tracking it closely, and I will see you in the next one.